Hey guys, this is Rhys Trenhaile from the Vanguard Team at Manor Realty down in Windsor, Essex in Ontario. With me is Alex Lister. We consider Alex Lister one of the top mortgage brokers in the area, especially for income property investments. So Alex, thank you for joining us today.
Oh, thanks, Reese. Appreciate the loving endorsement there. Happy to help.
I'm in sales, man. I'm gonna hype you up. Yeah, he walks on water,
100%.
guys. He gives bread from the unlimited basket. Yeah, unlimited bread from the
Do what I
basket.
can.
Um, yeah, for people that aren't Christian, those are Jesus references. Thank you for joining us. I wanted Alex on here today, guys, because there's a real conundrum that I am seeing from our investor base and our friends and family when it comes to residential real estate. There's a group of you that have your mortgages or a mortgage renewing, and let's say 6 months from now, and you know full well that if it was a year and 6 months from now, the interest rates would be about where you are right now. But you're dealing with a higher interest rate right now, and it's going to eat up the cash flow on your income property, or it's going to, make you have your kids eat more Kraft cheese and macaroni and a little less steak. So I wanted to ask Alex how he's handling that, because from our perspective, we're saying, hey, go variable rate and just ride that interest rate down that's predicted by three of the big five banks. Benjamin Tal, chief economist at CIBC, chief economist at RBC, McKenzie, they both say the same thing. All right. They're saying by the end of 2024, by the end of 2025, the interest rates will be down to 2.75%. And TD, their chief economist, says that the interest rates will be down to 2.25 by the end of the first quarter of 2026. So that would be March 31st, 2026. All fine and dandy, Alex, but if you need to renew now, what the hell do you do?
Yeah, that's those are some optimistic outlooks from the good old economists of the big six banks. I'm sure they've also looked at their books of business and are really hoping that that's going to be the case because they have plenty of mortgages outstanding right now that were qualified at
Benjamin Tal hasn't been wrong in over
significant
3 years
mortgages.
at CIBC.
Knock on wood,
Yeah,
he continues. Fingers
yeah,
crossed because it's best for
yeah,
everybody if those rates do come down.
yeah.
And I
If,
can see
if
that
you don't
being
watch
right
our
on.
if you don't watch our videos a lot, Alex, we've been pushing the investors to keep it simple because there's so many voices out there that
Mhm.
when it comes to the predictive models that are the most accurate, it's Benjamin Tal at CIBC and McKenzie at RBC. They haven't been wrong in donkey's years, and the other guys barely are wrong because they have access to so much data compared to the rest of us. So
Yeah.
when the journalists are looking for an opposing view, they go to the chief economist at Desjardins Credit Union. Well, I mean, that guy has 1/100th of the data to work with that Benjamin Tal has, and Benjamin
Mm.
Tal has 24 economists working for him, right?
Yeah. No,
So
plenty of
sorry, little
quants, plenty of good numbers, folks there. And,
yeah,
hopefully that optimistic outlook continues forth. But for the folks right now who might be
yeah.
receiving that renewal notice from your mortgage lender and you're a little bit shocked because you got in on that mortgage at 2% and now you're being offered 5.5, 6
Oh yeah,
on the fixed rate product. So what do you do with that, especially when your margins are thin as it is? Um,
yeah.
you know, you play it by year. Sometimes it's taking a look at your investment and identifying, okay, is the cash flow on this one strong enough to hold this? Because real estate as an investment asset is going to be a great long-term hold. So you want to hang on to your portfolio as long as possible to generate
Yeah.
more net worth down the line, which is really important. And there may be some points in tough economic times right now where those cash flows on the monthly basis might not be great. There might be a little bit of negative cash flow here and there. One unfortunate reality that Canadians are facing across the board is increased rent prices because you got all these investors owning these rental properties, and the biggest cost associated with them, the mortgage, the loan that's taken out, is going up. And there's a ton of new Canadians coming in who all need a place to live, and that's causing a lot of demand in the rental space for folks who can't qualify for a mortgage right away. Maybe they don't have the cash, maybe they don't have the
It's,
income, maybe they
it,
don't have the citizenship as of right now.
it,
If you're not a PR, then it's a tough call getting into a home in Canada with that foreign buyer's tax.
yeah, with the people that are waiting on permanent residence, we actually they're one of the three categories that we put into what's called rent to own
Mm-hmm.
programs,
Yep.
because we know they have the income. We know they have the down payment, but they don't have the PR status. So what we do is we get them with rent to own programs so they can basically lock in at today's rate. And then they might have
Yeah.
to, technically rent for a year and then refinance out the rent to own company
Mhm.
at the end of that year when they have their permanent resident status. So
Yeah, 100%.
this is a total aside, guys, but it's a really good program for people going through bankruptcy, people going, but it's going to clear off the record soon. People
Mhm.
going through divorce, and then people waiting on PR. Anyway, that was an aside. I do find it interesting. I'm realizing as you talk, your perspective is different from ours. Our perspective is our own client base, right?
Mhm.
Our clients cash flow. So when the interest rates jump up on them to 5% from 2.5%, they're still cash flowing, right?
Yes.
Because that's what we do. We sell them the best possible properties. They take
Mhm.
a kick to the shins, but they're not suffering. But you're
Yeah.
right. We pick up a lot of clients from other real estate agents and other real estate teams that didn't get a good property. And then they're coming to us for help, right?
Mhm.
And I guess we send a lot of those guys to you, right? So we end up
Yeah.
problem solving these things together. But you're seeing more of that than me.
It's reality, specifically in the single family market for rentals. If you're
Yep.
buying a single
Yep.
family home and there's only one unit in there, the margins just haven't made sense for anybody who's bought in the past 2 years because the property value is through the roof. And even with
No.
rates low as they were in 2021, it's hard to cash flow that property. Now, you guys do a great job, specifically with Steph and the ADU model and finding single family homes with
Yeah.
opportunities to segment into separate suites and get multiple streams of income. That really aids
Yes.
in developing those stronger cash flows and helping
That's
people
the only
weather
way it
some of
makes
this
sense.
storm. Hmm.
Yeah.
Yeah, 100%.
Yeah.
Density is a big thing that I hear you preach, and I do think it's from a city-wide and a province-wide angle, something that we need to be encouraging and building more and more units for people to live. It's just supply and demand in
You
that
have
sense.
to. You have to, man.
Mhm.
Yeah, we are getting a lot more. Yeah, like we're getting a lot more involved now in development, like helping people to develop. And I'm actually surprised how many local people we're working with. It's about a third. And I would have thought it was going to be a lot like our income property sales, which are 90% out of town. And give full credit to the local guys and gals that own property here. They want to know how to take that land or take that land with a small building on it and build 10 stories. And in a
Mhm.
lot of cases, they're not 100% driven by profits. They're driven by the fact that they know, and I know, and that our city's desperate for residential housing and residential density,
Mhm.
Um, but yeah, so okay. Uh, Coming back to, um,
What to do when you're
I'm an
renewal?
investor.
Yeah.
Yeah, I'm investor. I've got to renew in a month. It's currently July 4th, 2024. I got to renew August 1st, Alex, and I'm going to go from 2.5% up to a 5% mortgage.
Hmm.
And I want to mitigate my losses, and I kind of want to hang in there, take a body blow for a year until those interest rates come down. Let's assume that the chief economists at TD, CIBC, and RBC are still as accurate as they have been. Let's just assume
Hmm.
that for the sake of argument.
Yeah.
So we're waiting for those drops, but right now I'm going to take a kick to the shins. Do I go variable rate or do I take a 1 year fixed? And that's my biggest question for you today.
Hmm. So variable is likely the better option if you can stomach the rates where there are right now. It's unlikely that you're
Yeah,
going to experience a world where we have higher interest rates than we're currently sitting at. Again, knock on wood, because who
knock
knows? I
on.
can predict the future. But if
Yeah,
you're going with
yeah,
the variable rate, you got a couple advantages. One, your interest rate's going to fall when the Bank of Canada makes their announcements and drops their overnight rate. So you're pegged to those Bank of Canada rate reduction announcements, and those
yeah.
happen, about 6 times a year. And that's something that the Bank of Canada has full control over. What the Bank of Canada and these economists and the big banks don't have control or total influence over is the bond yields. And the bond yields are what drive fixed rate mortgages. So, a little bit of an example here using a 5 year fixed. Most of those mortgage products are pegged to the 5 year bond yield for
Yeah, it's
government
true. That
treasuries.
is true.
Same
Yeah,
thing
I
with
see where you're
1-year,
going with
3-year.
this. Yeah. Yeah.
And the bond markets are influenced by a lot outside of the Bank of Canada's control. The US economy is a big one. And if things are going out like
Yeah.
gangbusters in the States, as they have been, it's been doing better as an economy than we have, there's the potential for that divergence in the overnight rate. And what happens is if the Bank of Canada has to cut interest rates because across the board we're struggling, businesses can't get access to capital to keep the doors open, liquidity is a problem across the board, banks need to go
Sure.
into these overnight
Global
rental
meltdown
markets.
was like that. Yeah.
Exactly. And if our rates fall, but the bank or the Fed over in the States, they're looking at their economy, they see, unemployment isn't that bad, we're still doing fine, we got room to play. Inflation's more of a concern to us than affordability and unemployment. We're going to keep our rates high. Now what that's going to do is it's going to cause the devaluation of the Canadian dollar versus the US dollar. US is obviously pinned as a global
Yep.
reserve currency. And what happens there is
By the way,
everything that
guys,
we import.
Alex knows way more about this stuff than I would have thought. I thought he was just trying to look smart with those glasses today. But yeah, there's some
Yeah,
extra knowledge behind this. This is cool, man. Can
but
can I can I quickly summarize for the
yeah, 100%.
audience?
Yeah, absolutely.
Because we're getting close to 12 minutes. I think the takeaway, this is a huge takeaway for me, because you're right. The bond rate is more of an international phenomena, kind of like inflation. Like
Hmm.
blaming Joe Biden or Justin Trudeau for inflation, you might as well blame Mother Teresa for war. I mean, it's like they don't control that. It's a global phenomena.
Yeah.
Bond rate is a global phenomena. You're right.
Hmm.
But you're right. If you go variable rate, the banks in Canada do have control over what your mortgage rate is.
Exactly. Yes. So when
Oh,
all the guys
snap.
at CABC, Scotiabank, Benjamin Tal, all these guys are talking about the rates, I have a feeling they're discussing the overnight rate by the Bank of Canada as opposed to what the
They are.
bond yields are
That's
going to say.
exactly what they're describing.
Hmm.
Yeah.
So
And if guys, if you hear me interrupting Alex, we got a stupid lag going on right now. We're not being rude to each other. It's this lag. Um, Dude, that is awesome.
mhm.
I love when I can do these interviews and I can learn something. That is 100% correct. I knew that, but I wasn't thinking of it that way. It's exactly how you protect yourself if you believe that the
Mhm.
predictive models of the big three banks are still going to be accurate as they have been.
Yeah,
If you believe that,
100%.
then you go variable 100%.
And for investment
Oh,
properties
there
too,
we
I would
go,
advise going
guys.
variable
Awesome.
over fixed any day of the week for another big reason, and that's interest rate differential. That's your prepayment penalty should you have to liquidate or if you want to refinance your mortgage. If you're in a 5-year fixed for your rental property, for instance, and you wanted something secure, you
Yeah.
wanted to lock in your rate, but then 3 years down the line, you see, oh wow, rates have dropped by 2% on fixed rates. I can go out and get a far cheaper mortgage out on the open market now. I want to refinance to improve my cash flow. So the lender that you're with
Interest
on
rate
that 5 year,
differential will get you.
yeah, they're not going to be too keen because they had your money locked in for another 2 years at 2% premium to what they're getting at the market. So that's how this IRD is going to be
Oh,
calculated.
they
They're going
get
to
you.
take that 2% on the principal times 2 for the amount of years outstanding there. And you're going to see I don't know, 10, 15, 20, $30,000 prepayment penalty, depending on the size of the loan and depending on how much rates have dropped. You're going to be cooked. It's not going to be feasible to make that change. But if you're on a variable rate and say you do even want to sell the property because you just think it's time to get out, you want to get that early retirement, sell the rental properties, buy a boat, whatever you're feeling, your penalty is going to be 3 months interest on a variable rate mortgage. And that's all it's going to
I
be.
got if I was just saying a variable rate has beaten a fixed rate since 1975 when I was born, right? And
Mhm.
and I don't know if that's true the last few years because things were so screwy with the pandemic, etc. I got to look that
Yeah.
up. But I always went variable rate because I knew that the odds were not just in my favor, they were massively in my favor. If I gave you 99% odds, 98, I can tell you statistically, it's 98.5% that the bank's going to be right on the variable rate over their fixed. Because if you think
Mhm.
about it, guys, in layman's terms, When you're going into the bank and you're asking for a fixed rate mortgage, what you're really saying in plain English is, Mr. Banker, I want you to take on the risk of interest rate fluctuations for me for the next 5 years. I don't want that risk. Well, Mr.
Mhm.
Banker has an army of economists that's telling them, on a probability curve, where that's going to land most of the time. And I can tell you right
Mhm.
now, I'm nerding out right now, but it's called two standard deviations on a bell curve. And basically, they
Yep.
will win on almost the entire bell curve, except for that last extraneous piece
Mhm.
after the second standard deviation on the one side of the bell curve.
Yeah.
And that's a
Which is what we've
1.5%
experienced the
chance.
past, 3 years. Banks who locked in at a fixed rate of
Yeah.
1.5%, they're probably kicking themselves thinking, all our clients got a great deal, but we could have taken that money and lent it out at 5.
Yeah. Yeah. Well, but they borrowed that money from
That's true. It was all
the
on
central
contract.
bank at 0.25%. Yeah. So they're still
Mhm.
making money. They
Yeah.
make their
100%.
delta. Don't. Yeah. They don't, man. They don't lose money, man. They
No,
don't.
no, we're not in the business of
They just,
losing money.
yeah, if you think you're going to beat the banks on fixed rate, you're smoking stuff that
No.
Justin Trudeau just made legal a few years ago. Um, Alex, thank you so much for joining us, man. We're kind of at the end of our time, but dude, I learned today, and I appreciate that about you, man. Thank you.
Hey, anytime, man. Always happy to, discuss this stuff. I get high on it. So cheers, mate.
Let's do it again. Let's do it again. Let's do it again. Yeah, let's
Oh
do it
yeah,
again
man.
soon,
We need
man.
that fix. All right.
I'm Rhys
Cheers,
Trenhaile, the
man.
Vanguard Team at Manor Realty. This is one of your top mortgage brokers in Windsor, Ontario, especially for income properties, Alex Lister. Guys, as always, you can subscribe below, you can link below, and you've got links to everything, including joining us on our Facebook investment group. And if you want access to all our exclusive listings, join our mass email list. You can do that through the ClickFunnel link below this video as well. Thanks, Alex.
Thanks, Rhys. Appreciate it.